Well, a happy new year to everyone. Thank you for joining us, giving us some of your time, and we wish you well in this new year. And we want to give you a bit of a look back over the past year. Derek's going to lead us on this one, tell us about how we did. It was a year that I would say was very respectable, and it was a good year in
Hmm.
the markets as well. Over to you, Derek.
Sounds good. Thanks, Mark. So, as Mark said, it's a good year in the markets. I'm going to go through the returns on our various strategies and try to give some context to the returns as well. So, we'll start with our Canadian momentum strategy. This strategy's goal is to beat the Toronto Stock Exchange. So, for 2024, we did 18.3%. The TSX on a total return basis did 21.7 or 21.65. So, underperformed. But one of those, it's one of those things where, if you're over 15% in a year and you underperform slightly compared to the TSX, it's not the worst thing in the world to be at 18 instead of 21. And if we look at 3 year and 5 year on the same strategy, we are still outperforming the TSX. So,
That's what I was going to ask you, Derek. The numbers, I just looked at them here. On Elaine's account, so that's specific, her return
mhm,
was 14.5, and the number that shows on the TSX is 7.7.
right
Over
over what time
it's over
period?
5 years. That's 5 years.
Yes. Yeah,
Yeah.
exactly. So happy with 18%. And I should mention all these returns are before fees. Moving on to our
One
enhanced.
more
Okay,
comment on that one, Derek. Some people will see a different number for the TSX.
that's
The
right.
number that they'll be seeing is 17.99. We'll talk about that as compared to our 18.4.
That's right. So oftentimes when the TSX is quoted in the financial press or anywhere really, they're just talking about what we call the price return. So the stock price of all the constituents of the TSX went up 18% last year. The
Mhm.
total return is what we use as a benchmark, and that includes the dividends. And the TSX is a big dividend paying index. And so that's why it's such a substantial difference between the 18 to the 21 and point 0.7.
Good. Thank you.
Okay. Moving on to our enhanced index strategies, right? We're going to talk about returns on the aggressive growth or our 80/20, as well as the growth or our 65/35. So enhanced index aggressive growth did 14.4% for 24. It has a benchmark. What we like to look at and compare with is the Morningstar, which is a big fund sort of
Mhm.
management resource. They prepare target risk portfolios, something you can compare to and see if your portfolio is doing as well as it should be. So their moderately aggressive target risk portfolio, which would be comparable to our aggressive growth, did 10.7. So we're nearly 3% higher than that. Or sorry, that's bad math. Nearly 4% higher than that.
Yeah.
So we're quite
And that's
happy.
because of the diversification. There's some fixed income, there's different markets, and we still did
That's right.
14.4 against a benchmark that would be around 10 and a half. Okay.
That's great. Yep. And for the growth, that's the 65/35. The Morningstar moderate target risk portfolio would be the comp for that. And it only did 8.3 versus our 12.4 on our enhanced index growth. So again, really happy with those returns. As you can see, we're all
Hmm.
double-digit returns for 24. Strong year on the market. Really, really good. The other strategy I want to talk about is our new one, the Canadian High Dividend Strategy. So we've got a number of clients in
Hmm.
this now. Started with Mark in August. So September is our first full month, excuse me, and it did 6.3% in those 3 months, September, October, 4 months, September, October, November, December. And the current yield or the yield at the end of the year was 5.92% on the
Now,
strategy.
December was a rough month. What do you think happened there? And let's talk about the market coming up this next year. What do you think happened in December?
Well, December, what we saw happen in the States in particular, they were leading the way with this, and they've been leading the way sort of for the last little while. Um, we had the Trump bump when he was elected. Donald Trump was elected president in November. Markets
Hmm.
rallied pretty significantly following that. I think it was November 5th election result for the month of November. And then I think, it was just a little bit of sanity coming back to the numbers a bit to say, okay, we ran up a little bit too high in November. Let's bring some reality back. Additionally, if you're listening to this, there was a bit of a pullback as we're recording. It was yesterday, Friday the 10th, but in the market, and that's because the U.S. market jobs report came out for December, and it showed really, really strong. Now, I think that can be a little counterintuitive to say a strong jobs report is making the market fall. But the reason is because if there's a strong jobs market, there's low unemployment, the Federal Reserve is unlikely to cut rates because they don't need
Mhm.
to. And so the market is pricing in now higher rates for a little longer. So
Good. Okay.
it's all of that.
Okay. Changing subjects, and we're now at 6 minutes. Um, you have been testing a new strategy in the momentum in the US. Talk about that, and what are your thoughts on rolling it
That's
out?
right. That's right. If you're familiar with Tower, we've been promoting our Canadian momentum strategy for years now. It's done extremely well. It's beat the benchmark. We want to roll out a similar strategy in the United States, biggest market in the world by far, and we want to use the S&P 500 as the benchmark. So we've been trialing this in my own personal account with actual money because that's how we do things, Tower, for the last, I want to say 18 months or so. And happy to say for 2024, the strategy was up 25.9% versus the S&P 500 at 25.02. So a slight, 0.7% or 0.9%
You're not complaining about
outperformance.
that return in your account.
No, no, not we're
Okay,
complaining about that
good.
return.
Mhm.
But, we've been playing with some of the parameters on the strategy, and I really think we have it nailed down to where
Dialed
we
in.
want it to be. Yeah, to where we want it to be. And that does take me to, sorry, go ahead. Go ahead.
Nope. Tell us a little bit about what you did to dial it in.
Okay, sounds good. This is actually it was actually kind of interesting. I quite enjoyed it. I developed I used some chat GPT actually to help me develop a code that I put into Python that downloaded 2 years worth of returns, daily returns for every constituent member of the S&P 500. So it's 500 names. That's why it's got its name. 500 names, daily returns, so about 250 daily returns in a given year, and the volume of each daily return for all 500 names for 2 years. And then I put this in a spreadsheet and linked all the tabs and did some calculations on correlations to see, okay, what factors are actually leading to, quarterly performance. Our strategy looks
In the
in the
future.
upcoming quarter, yeah. So we're looking back to say what historically in the last 2 years has been, can be correlated to higher returns in the upcoming quarter. And our hypothesis or our suspicion was, we've been using price as an indicator, but we suspected that volume combined with price in an effective way can be a good indicator for performance. Um, I put this all in the spreadsheet and started to do the correlations and check it all out. The spreadsheet ended up being, 250,000 lines long just because that's all the numbers. I mean, you can do the math, 500 names times 250 days times another 250 days,
Mhm. Volume.
anyways.
Mhm. Yeah,
And so it was a big spreadsheet, but it did show historically we have a special now we're adding to the strategy a volume adjustment. And so, it's
good.
that's the work we do.
So we've got to get off this call. We're about 10 minutes.
Yes, we do.
What do you want to roll that out this year, or are you going to work it a little longer?
I think we do want to roll that out this year. I mean, we're gonna, fully implement the volume adjustment come the March or Q2 rebalance as we go into Q2.
Mhm.
And I think from there, we'll see how Q1 does. I think from there we can take a look at rolling it out into several clients as it's appropriate for those clients, and we'll reach out to those
Right.
who
Okay,
it is
so one
appropriate
one
for.
quick question. You are now using the momentum strategy with that volume dial, helping you pick for your own account for this quarter, and we'll do it for the next quarter. Maybe we roll it out July 1 this year.
That sounds like a good time. Yeah, maybe we roll it out for client accounts July 1. Yep.
Okay. If you think that that might work or be of interest to you, let us know. We'll take a look at your portfolio. Call Tarek, call me,
Hmm.
and we'll see if the right word is if it's suitable in the eyes of the regulators.
That's right.
Tarek, give us a closing. Happy New Year, everybody.
Happy New Year, everybody. Let us know if you have any questions about your accounts, about your returns specifically. You're going to look at your account returns. They might be a little different than what you're seeing. We're happy to chat about that, why that is, or what's going on there. And we hope you had a good holiday season. We look forward to the new year.